Hello, my name is Belinda Dunn. I am the Adult Services Librarian here at North County Regional Library. Welcome. Look forward to having a great session today.
And I'm Shelby Benson. I'm the Director of Outreach for the Mecklenburg Bar Association, helping Belinda here get these sessions set up here for the next couple of months. And this is the first one that we've been able to do.
And I'm Rick Yandel. I'm a tax attorney. I'm a tax defense attorney. Um, Litigate tax disputes. I'm not a tax planning or anything like that. I'm an after the train wreck kind of guy. Um, I'll go ahead and get started here. The idea here is just give some tax law essentials, some basics to hopefully try to keep you out of trouble. Again, I am a defense attorney. I defend audits. I defend IRS criminal investigations. And we do some workouts, financial workouts as well, some innocent spouse and some other things, mainly litigation oriented. Um, okay, so we'll go ahead and get started here. Let me go into the fancy view, presentation view. Where to go? Nope, nope, nope. There we go. Okay. I am a lawyer. I'm not your lawyer. This is a general information session. We're just speaking in generalities. Um, Nothing is tailored to any specific situation. I'm not giving specific legal advice. This is just general things to consider as you go about your business, and hopefully you get other professional help, either accounting, legal, and whatever. Um, if you're the idea here, we're talking about businesses generally, small businesses, Schedule C, self-employed, that type of stuff. Um, Hopefully you have a team or some professionals to help you. Okay. Um, Again, I do represent dispute taxpayers with disputes. I like to say I represent misunderstood taxpayers. Um, Workouts. Well, I hate to say back taxes because that implies, we have a file and all that kind of stuff. But when we do workouts, financial workouts, sometimes a bankruptcy, I don't practice bankruptcy law, but sometimes we'll work with a bankruptcy attorney because relief from tax liability through bankruptcy can be a thing and a very beneficial way forward. Uh, I do not give advice on how to prepare a return, or what the best way to do a return or how to structure things. Part of the reason there is that that could be a waiver of the attorney-client privilege. If I tell you how to do something or what to do, and you do it, that attorney-client privilege can be waived. I've gone from being counsel to co-conspirator if something goes bad. So it's a very, very sharp line in the sand. If you need compliance help or planning help, you need to go see a competent CPA that does planning scenarios. What if you run the scenarios, or an attorney? Some attorneys do planning, particularly estate planning. Um, I do not, but those would be the teams that would help you in that situation where you're wanting to know how to arrange your affairs. Those people, similarly, if something does go wrong and there's a defense matter, they're probably going to kick it back to someone like me because they're probably conflicted out. They would have a conflict of interest in defending this arrangement that they recommended or were instrumental in putting forward. So it's a bright line in the sand. I'm the defense attorney. Okay, so I one of the main pieces of, let's see, do we have chat here? I see a chat. Someone's at the library. No problem. Okay. Am I am I speaking to small business owners? I mean, or people who are contemplating a business or have a business, and maybe there's already been some complexities or some problems. Can we just put in the chat what kind of issues we're dealing with for participants. Don't everybody type at once. Okay. All right. Here we go. Okay. New sole proprietor. Okay. All right. One big piece of advice I would give, and again, I'm not telling you how to arrange your things. LLC after corporation not launched. Okay. All right. Home care business LLC. Okay. Is to keep it simple. For I can't tell how many people I've seen have come to us with a mess, penalties, sales and eBay. Yeah. And it comes to me, and it's a Rubik's cube of entities, and an LLC, an S corp, a C corp, a trust, all this stuff, and no one remembers how or what this structure was supposed to accomplish or why it was there. Some of these entities haven't filed returns. Keep it simple. It's a lot of people have single member LLCs. I mean, and that's a great thing. It's for tax reporting purposes, it's referred to as a disregarded entity. The business goes on your 1040. It's a form. It's a Schedule C, profit and loss. Yeah, own your 1040. All right. There's no balance sheet. There's no other schedules. It's really just those. I mean, there are a few minor things, but it's very simple. It's no simple way you can go. Now to do that, it does have to be a single member LLC. If it's a two-member LLC, like a husband and wife, or two other members, it's really not a sole proprietor. It really needs to have a partnership return or some other kind of return that you elect. The problem, or a problem, with these other entities like a partnership or something like that is, first off, they're complex. I mean, partnership returns are not straightforward. It's a Form 1065. There is no 1065 EZ. I don't know if you remember, there used to be a 1040 EZ. They got rid of it, but they've added a 1040 SR for seniors, and it's pretty much the same thing. But there is no partnership EZ or an S Corp EZ or C Corp EZ or anything like that. Those are complex returns, and they get more complex every year. There's more and more questions, more and more disclosure. It's going to complete like that. And one of the problems, like for the partnership, is I was supposed to file a partnership. I didn't know. I went to my accountant. They put it on the Schedule C. But apparently I had this partnership out there, and maybe two partners, K1s missing. Well, the penalty for that was $500 per month. Penalty for late filing was $500 per month per partner. And you're finding out about it 2 years later. And you got $50,000 of penalty, pretty quickly. All because, for no real reason. It didn't need to be there. The same goes for S corporations. C corporations have things. Some people want to have a business and a trust, and that's a mess. There can be times where you've grown into that complexity or the need for that level of complexity. But for starters, for basics, I strongly encourage you to keep it simple. Just basic, own your Schedule C, and stay compliant. Far less risks of misfiled returns, wrong due dates, audits and penalties. Much better keeping it simple like that. Hopefully, I'll probably beat that to death. But consider keeping it as simple as possible. There are plenty of people out there that are going to say, "Oh yeah, we're going to save you money. We're going to create this entity and then that entity." Yeah, I mean, you're paying. First off, you're probably paying someone to prepare the returns. Hopefully, if not, you got another problem, or you're paying them and then it's messed up. Anyway, keep it simple. Always, I would advise you to always file the tax return. Feel free. I don't have a whole hour worth of stuff here, so feel free to pop in with questions or stuff, and I'll try to answer. But another thing that comes up is I would always file the tax return. Some people, so I didn't make enough money, well, or something like that. Always file the return, and particularly with states as well. First off, let's say there is a de minimis level of income where you're not required to file a return, And that's gross income, not net income. Not like, well, I lost money that year, so I didn't file. You know, the IRS didn't know you lost money. The only way the IRS would know that you lost money is if you filed a return saying you lost money. Otherwise, you know, they just have what they have, and they're going to go on, and you're going to wish you had filed a return. A zero return, you know, it's the best time to file a return. Perhaps you have losses and you can carry those losses forward to other years. In some cases, they're carry back. Sometimes, other times, mostly it's carry forward. But you're not creating those carry forwards unless you file the return with the loss. So, you know, if there's a loss, there's not going to be tax due, you know, from that activity. You may have wages and stuff, but so I encourage you to always file that return. The statute of limitations on assessments, audit adjustments, and such doesn't start until you file the tax return. So, you know, I've had plenty of people who have, you know, they didn't file the tax returns, you know, 5 or 6 years come by, suddenly they have this big balance, they call the IRS, find out what's going on, all had an audit. Well, how can they audit me? I mean, that was, you know, 6 years ago. In their statute of limitations before that, you know, keeps them from adding new tax, you know, after so long? Well, there is, but that statute of limitations never starts to run until you file the return. So if you want the statute limit, and the statute of limitations is your friend in tax compliance. So if you want the statute of limitations to start, you got to file the return. That establishes the start date. If you don't file a tax return, what here's the way the IRS handles this is that after 3 or 4 years, you have the right to file your own return. If you don't, after about 3 or 4 years, the IRS, in the big data analysis, they will churn the data, and based on the information that's reported to the IRS, 1099s, whatever, using that information and only that information, they will generate a substitute for return, SFR, substitute for return. Now, they don't have your cost of sales. So if you have an eBay, you know, you're selling stuff on eBay, the IRS gets a 1099. Now you can say, well, I didn't get my 1099. Well, it doesn't matter because the IRS did. So, you know, you might as well get your 1099. And it's not the 1099 that makes it taxable. It's the fact that you received it makes it taxable. The 1099 just makes it traceable. I see the statute of limitations. I'll talk about that in a second. So the IRS will file a substitute for return, and I give this spiel day in and day out. Substitute for return has 3 main characteristics: 1 within bankruptcy, 2 within the IRS. Let me just talk about the IRS and not talk about bankruptcy right now. But within IRS, the substitute for return is a provisional return. And what that means is that it is the tax return lawfully due and owing until such time as you file your own return, if you so choose. You don't have to. You can accept the SFR. Probably not a good idea. But the other, or you can file your own return to replace it. The other attribute of the SFR, and this is why filing your own return is so important, is that it is a protective return. What I mean is it protects the interest of the Treasury. It's not designed to be the correct tax return, just the opposite. It's designed to be the maximum potential tax loss to the Treasury, so the collection process can begin and the Treasury's interests are protected. If you don't like that amount, you can file your own return to replace the SFR, but in the meantime, that amount is lawfully due and owing. So you sold $500,000 on eBay. You got 1099 for $500,000 of sales, okay? But you said, well, you know what? I lost money that year. My cost of sales were higher and other expenses were higher. I lost money. I didn't file the return. Well, the IRS doesn't have all that cost information. They just have the sales. So on the substitute for return, it's going to be sales, $500,000. Expenses cost $0. Profit, $500,000. And tax and self-employment tax and penalties and interest, everything on that. And that is the substitute for return. People say that, yeah, I didn't file. They filed one for me, but it's not right. It's not designed to be right. If you want the right return, you got to file it yourself. And you still can after the SFR. It's a lie. It takes forever. If there's an SFR return and then you file your own return to replace the SFR, gosh, it can take 9 months, a year for that SFR replacement return to post. Whereas if you get a warning that there's going to be an SFR unless you file your own return, and you file your own return right away, then it posts in the normal time frame. So it's always in your interest to file an SFR. I mean, file a tax return. And even if you just it's required if the business has no sales transactions in the year. Okay, well, here's the thing. I mean, it's not required. I mean, there may be some other requirements, but you want to file the return. If it's zero, I mean, I have on my side, that's the best return to file. The way you tell everyone, look, my business was suspended, it was zero that year, I haven't liquidated, but it was zero. So file a return that says zero. And get statute of limitations running. Statute of limitations, the question, basically it's 3 years. There's multiple statute of limitations, but statute of limitations on assessing additional tax from an audit is generally it's 3 years from when the return was filed. So, yeah, as you say, I'm not going to file a return because, I had no sales that year. Well, you definitely want to file that tax return until you liquidate the business, or there's a box to check that on the top that says final. And if it is your final year, file the Schedule C with zero sales and check the box that says final, and that will tell the IRS system not to expect one following year. So, am I required to? You're not required to, there's a lot of stuff that you're not required to do, but you just leave a big mess behind you everywhere you go unless you just, clean up after yourself, do everything, move forward, and let's finalize this, wrap it up, let statute of limitations run, and move on in life. I mean, it's heartbreaking when you see things come up from 10 years, 20 years ago. So how can I go back that far? Well, you never filed the return. And that does happen, particularly in states. So hopefully I'm beating this horse here, but you've got, highly recommend always file the return. I used to work before I became an attorney as a CPA. I'm still a CPA, credentialed CPA, although I don't prepare returns or practice that way. But at one point I worked in a corporate tax department. It was a big, huge international firm. Not a firm, but it was a international construction company, I worked in the corporate tax department for a while, and we had like 50 subsidiaries in all different states. It was a big, huge deal. But the new guy in there, and me, when I was the new guy, all I did was file zero returns in 0 states. We had dormant entities that have been, they're open for being sued, or for whatever reason, we keep it open, or they've left a state, and I'm doing, Colorado or Wyoming. And they haven't been in Wyoming in decades, but you better believe we're still filing a return, zero return every year in that state until that entity is formally dissolved. So zero returns can be your best friend. Sometimes they're referred to as protective returns, zero protective returns. That's not a formal name. There's no box to check that says protective. But if you think, if you're just being protective here, you don't know what's going to go. You haven't finalized it yet. You haven't liquidated it. You haven't checked the box that says final. Perhaps in another state, I'm talking about state returns, maybe that other state might think you're still in business there, might think you still have a resident there because you have storage space there or something. By all means, file those. For the other states, you want to file a non-resident return just to get that thing, because the states come back. If the state thinks that you need to file a return and you don't file a return, either a non-resident or whatever, zero return, that state is going to assume that you're a resident, full year resident of that, even though you haven't lived there in 6 or 8 years. And they're going to send you a full year resident return. And then you're playing defense trying to get them to accept your non-resident zero return. Whereas if you had filed it timely, they only have 3 years. States differ, but basically 3 years to try to put forth that you were in fact a resident instead of a non-resident. And they may not make that deadline. If you don't file, they have all the time in the world, and they will come after you. That can be a tough slog because you don't always win. I mean, sometimes you say, well, I left that state, and well, And now I'm in North Carolina or somewhere else. I haven't been in Wyoming in 8 years. It's like, well, what? Sometimes you just don't win, even though you were right. You still lose. It's a hard fact of practice of law, but you don't always win just because you're right. So you really want to have the procedure behind you, buttoned down and protected, and you get that protection by filing these returns. The federal returns, zero return, protective non-resident zero returns. Get those things filed. So I can't harp on that enough. Let me see. What year, but never long. What business was year ago? Yeah. Here's the thing. Okay, we talked about the no sales. I would still file a return if it was incorporated. You figure out what you're going to do there. You're going to liquidate it. Yeah, consider liquidating it. And if it was incorporated, so I'm guessing that you're talking about an S corp or a C corp or something. Yeah, consider. I'm not your preparer, but consider filing. Is it when you file those corporate returns, S corp, C corp, even partnership? There's a box to check that says initial return, and there's also a box to check that says final return. Consider in a situation like that, in the year of dissolution, filing, checking both of those boxes. Well, if it's your first year, check both those boxes: initial return, and most importantly, final return. Check that box that says final return, so the computer system knows not to look for the next year return. So, talk to your preparer about that. But the way you tell a big automated system not to come looking for the next year's return is to check the box that says final. Okay. All right. Any other questions? But before I move on to types of audits, any other questions about the need to file? No? Okay. All right. Okay. Types of audits. It's really three types of audits. And I'm talking about at the federal level. The federal level, the most common type is what's called an automated underreporter unit notice, AUR. I refer to these as, excuse me, as junior varsity audits. It's just it's an automated system. Every return that's filed goes through an automated cross-match system, and if something doesn't match up, you'll get this automated notice that says you left off a W-2, or you left off a 1099, or you left off a W-2G gambling things. So one thing we're seeing is you left off a 1099 that was for gambling. Those are problems. So anyway, and all returns run through this cross match thing. It's a thing. We can deal with it. And I'll talk more about it. Another type of audit, or what are called campus audits, similar to AUR units, but usually they're not just things that are left. They come from a centralized campus like Ogden or Atlanta. Just a parentheses here. Ogden or Atlanta, Philadelphia, something like that. And there's usually one or two issues. You claimed a 5th year of American Opportunity Credit, and you only get 4 years. You deducted $250,000 of business expenses with 0 sales. That's not going to fly. These are single year audits. Lots of typos here. Single year audits, usually only 1 or 2 issues. So you just work those issues. And they're rolling out the capability to upload a response. You log into the IRS website and you can upload your response. And that's pretty helpful. I'm going to talk more about each one in a minute. And then there's the old school local desk audits. And that's what most people think of when they hear about audits. That's where you go, if you're in Charlotte, you go to David Taylor Avenue, I think it is. And there's examiners there, and you go in and you go to conference room and you lay out all these records and stuff. And those, they're less common. They're supposed to be bigger dollars. But the thing about those is that the examiner is expected to look at surrounding issues. So it was sent to them for one reason, but they look at the other reasons, the other forms, and they're supposed to look at the other years that are in statute for assessment. So usually there's, well, I'll talk more about it, but 2 or 3 years. Okay. The automated underreporter, millions of these go out every year, millions come back in. It is automated, that's keyword. It's here's the thing on responding to these. When you file your tax return, your forms and schedules are taken at face value. You don't have to prove anything, attach proof, explain anything. In fact, it's better if you don't. It's a forms processing operation. The forms processing center, no one's reading your explanations or looking at your proof or evidence or anything. It's just a forms processing operation, and the forms are taken at face value. They're subject to audit. They're subject to the cross-match audit, this AUR, automated unreporter, and they're subject to full audits also if the numbers warrant. But initially, they're taken at face value. When the AUR unit notice comes out, initially, but if you can respond with a corrected, previously omitted, or corrected form or schedule, those forms and schedules too are taken at face value. You don't have to prove anything. You don't have to call, yell, cry, explain, boo-hoo, all that stuff. You just have to respond, and this covers over 98% of the situations. You just have to respond with a corrected or previously omitted form or schedule. You left off a 1099 from eBay, and you don't have a schedule. You didn't have a Schedule C on the return that you filed. You just respond with the Schedule C that includes this income and your other expenses, and attach C, previously omitted Schedule C attached. It's taken at face value. You don't have to prove anything. I get people upset. They're saying they're saying I made this money on these eBay sales, but I have all this cost, and they're not taking any of that consideration. Well, first off, they don't know about it, and secondly, the way you put that in is on a Schedule C and respond. You just respond, and if it's out of whack, it may be, you may have a regular audit later on it, a desk audit or something, and we've had cases like that where tell someone CB 2000, look, you have to respond to Schedule C, and they respond to Schedule C, but that Schedule C, it's $2,000 of sales and $250,000 of expenses, and good Lord. So okay, that's what you did. We didn't do it, but don't be surprised if it comes up for a regular audit, and then lo and behold, it does come up for a regular audit. It's a different process. It has nothing to do with the automated underreporter unit. It just came up for audit. Okay, campus audits they're similar to the automated underreporter unit in that it is a centralized campus. You don't go into that local office. It's usually, there's one in Brookhaven, New York, New Jersey, New York, I think, Ogden, Utah, Philadelphia, a couple of campuses. And it's a high volume operation. I would say it's semi-automated. The notices go out and they're assembled with paragraph codes. And sometimes the paragraph codes, the wrong paragraph code gets used, and there's a paragraph in this letter that makes no sense whatsoever. It happens. If the letter doesn't make sense, don't assume it's because it's special to you. It's just the way it came out of the system. And if you want to respond to it and you upload it, but here's what gets a lot frustrating with campus audits is, okay, someone took this initial data and generated the paragraphs and then spit out the notice. Okay, when you respond, it's going to land on someone else's desk. It's not going to land on that same person's desk. There is no one auditor that is for you. They used to try to make it look like it was. It would say, attention, Mrs. Green. Mrs. Green was one of the campuses. But it's whose ever desk it lands on, that's who's expected to work it. So they're going to work what you send a revised letter. Either we accept everything that you said, or we're not accept anything, or we accepted partial, this, that. For the rest, you need to send us this, that, and the other. So you get a new letter, new notice out. And so, well, gosh, it's kind of, I did that, but nonetheless, I put it all together, and you send it in, it lands on someone else's desk. Someone else takes a completely different take on it and puts in a letter, oh, you need that other thing and that thing. So, yeah, it's a different person every time. So, and that's, I can't change that. I mean, it's just, we try to make it as simple and straightforward as we can, upload it. There are appeal rights, you don't get too bent out of shape. We generally say that if on these campus audits, if there's any complexity at all to the matter, it's probably above the pay grade of what we can get resolved in the campus unit. I mean, that's just the reality. and we'll put together a response, but don't get bent out of shape if it's just, above their reading level or something. Okay. And in all of these, we have appeal rights. I'll talk about that in a second. But the desk audits are becoming less and less common. These are the ones where you go to the office at David Taylor Boulevard or David Taylor Avenue, I think it is. You go there with your documents. They sit there and they go through it. And they can, like I said, they can look at the other year. They're expected to look at it. The examiner, in this case, the examiner doesn't know why your return was selected for audit. A lot of people think that and the examiner did not select it. The big computer system in the sky selected this audit, this tax return, and assigned it to this examiner based on, there's a scoring system. I'll talk about that. And there's resource availability and backlog, and using those are the main two parameters. It gets assigned to an examiner. So examiner gets it, sends out the letter to the person, and they want you to come in for an interview. They're usually trying to get you to come in for an interview. Yeah, you don't have to go, by the way. If you're in this situation, give me a call. You don't have to go. Almost always get out of going, and almost always it's better if you don't go. There are exceptions, but that's the general rule. So anyway, so you go in there and you always ask, why am I being examined? And the examiner may say, well, it's probably because it's this and that, but really the examiner doesn't know. It just showed up in their inventory. And these are the highest risk audits because everything's fair game. In all the others, the underreported units, the only thing at issue is that unreported item, the missing 1099, W-2, whatever. That's the only thing at issue. And, any cost basis or expenses or whatever that offset it. The correspondence office, it's just those issues. Okay, you took an opportunity credit, you're in the 5th year, you only get 4 years. That's the extent of the risk. It just doesn't get much worse. You may lose completely, but it's pretty finite. The full scope one, everything's on the table. Everything's is up for grabs. The examiner is supposed to look for whatever, make a full scope examination. So, and there's risk there, and it could be there's a thing referred to as an eggshell audit, where really there's a criminal investigation behind it. The examiner might not know or has very limited knowledge of it. But sometimes it's a pretext for a criminal investigation. That does happen. Let's see, we talked about, I'm going to circles here. Automated reporter, you just respond to it. Campus, you don't call and talk about it, argue about it. Some people do that and want to cry. And I called and I talked to agent so and so, and her badge number is so and so, so and so. That's just not the environment. It's like examine it. The example I use in the old days, if you called an airline and tried to book a flight, with the reservation system, it's all online now, but you used to call a reservation center, and then something's wrong, you call back and you want to speak to that same reservation agent. No, it's just a call center. And the campus audit is similar to that. It's a center, and whoever gets it gets it. And it's a high volume center. They don't have a lot of time. So you give the substantiation, keep it short, simple. We want explanations to be, basically, we say if you can't get your point across in the equivalent of a PowerPoint slide, but we got a problem. We're off on a tangent, because they're not going to digest or consider much more than a few PowerPoint bullet points. I'm entitled to this credit because it meets the criteria. It's a substantiation. I haven't exhausted all of it, and that's it. You don't need to talk about anything else. The desk audits. Let me talk briefly about DIF scores. Desk audits get assigned based on DIF score, DIF, Discriminant Inventory Function score. It's a big data analytic score. Every return that's filed is scored like this, and it's similar to a credit score. It's a predictive score, and it predicts the likelihood that upon examination, this return will yield understated income or overstated deductions. And it's not perfect, but it's pretty good. So the IRS prioritizes their inventory of tax returns based on this DIF score, and they assign the highest DIF score to the available examination resources for desk audits. And when those resources are exhausted, that's it for that year. So I have had people say, I get audited every year. Well, it's because you file the same tax return every year, and it's the same sky-high diff score every year. So yeah, they're going to audit it. You don't want to be audited every year. File a more reasonable tax return. Now there could be some examples where it's a high diff score, but there's a reason for it. It's not a perfect system, just like a credit score isn't perfect, but it's pretty good. I mean, that's pretty efficient use of resources for the IRS. Okay. Okay. Yeah, examiners usually request in-person interviews. We can usually get you out of it. If there's anything that to take away from this is if you get a local desk audit and the auditor is asking you to come into the local office and you don't want to go. If you want to go, some people want to go. So no, I want to go and tell my story. Have at it. But if you don't want to go, and maybe legitimate reasons you don't want to go, the first one being you might make it worse. Give us a call, or whoever, a CPA or an attorney would be better for this. You might not want your preparer helping you with this because there's a conflict of interest. Your preparer wants to make sure that there are no preparer penalties, that the preparer is not liable for things that he doesn't know. I throw preparers under the bus all the time. I mean, I just can't penalize my client for this. The preparer did this. So, okay, and books and records requirement. This is a big deal. Let me okay, we get this a lot. The requirement on a business return, and well, in general for tax returns, but it comes up more for business. The requirement is that you keep books and records sufficient to file a complete and accurate return. All right. The requirement is not that you keep receipts. Receipts are not books and records. Receipts are a component of books and records. But receipts alone are not sufficient. If there's an audit, you're going to need to be able to present ledgers, journals, lead sheets, records to support the amounts claimed. Going in with a box of receipts and expecting the examiner to go through and compile them. So, oh yeah, this is travel. Oh yes, this is advertising. You can use this one for office supplies. Yeah, that's not going to happen. They're not your audit. I mean, they are your auditors, but they're not your accountants. They're not your bookkeepers. They're not going to compile your receipts and into a set of books and records to support the tax return. It's not going to happen. I know that's a hard lesson. I've been in tax court before where I was just furious. My truck is in the parking lot. I have boxes and boxes of receipts, and they won't even look at them. That's right. They're not going to look at your boxes and boxes of receipts. I mean, that's not their job. They may look at your books and records, and they may trace some of them to receipts, but to support your audit, you need books and records. And generally, that's if let's say if we're on your Schedule C, you have advertising, line 9, advertising. I think it's line 9. You need a list of transactions, and you got $10,000. You need a list of transactions that account for that $10,000, and it needs to have who it is, date paid, such and such, and then be able to be traced back to a receipt or a online order or some third-party documents. That's what it takes to substantiate an audit. And we've had plenty of audits where look, you probably did spend all this money, but you just don't have books and records to support the deduction on the tax return. It's just not there. I mean, you can still create it. We're going to hire a bookkeeper. No, I don't want to pay a bookkeeper. All right, well, we'll pay the IRS the tax then. Okay. All right, let me get to this. Okay, I see. We can't be asking about specific book of record, QuickBooks. Everybody uses QuickBooks. I use QuickBooks. But I'm a CPA. The thing, it's powerful. It can be a powerful tool, for sure, but it does not make a non-bookkeeper or a non-accountant into one. You can key stuff in. It can be great for data collection. I get frustrated with it. I mean, I have things going in and out, and at the end of the year or something, I'm going through. It's like, oh man, this is a mess. I should have been keeping up with it, but why can't this thing just automatically keep itself straight? You know, I gotta go through and clean up all this stuff and it's going to wrong places. This is the same as that, but you know, you know, it needs more. I'm surprised in the day of, you know, AI and stuff. And the QuickBooks is not better than it is. Um, yeah, I constantly put spreadsheets out and reports out of QuickBooks and into Chat GTP for analysis and stuff. But that's not going to, I wouldn't count on that, you know, for audit books and records, at least not at this stage. But you know, if it's someone needs to know what they're doing. Either, you know, if you are an accountant or bookkeeper and you want to keep your books, you know, QuickBooks straight, that's great. And you have your third-party documents, your you know, receipts, but now it's all online, you know, order confirmations and shipping and confirmations and stuff like that. You know, if you have QuickBooks and have reports and can tie all that together, it's a lot of time. It's very time consuming. I get frustrated with it at year ends. This is, why am I spending time on this? You know, should be, it's because I'm a sole proprietor is why. I don't have anyone else, but for that, I don't have anyone else. So, you know, QuickBooks, you know, it's, you know, I don't want to say, you know, it's bad. I mean, it is good, but it's not going to replace somebody knowing what they're doing. It doesn't take a bookkeeper, non-bookkeeper, and make them into a bookkeeper. I've gone into accounts, people give me access to the book, you know, QuickBooks data, and I'll log in. And you know, I'll tell you one thing, coming from an accounting background, is that amateurs look at income statements, professionals look at balance sheets. When you look at your books and records, your professional is going to go to the balance sheet first, the assets and liabilities. If you see a bunch of negative assets and negative liabilities and open balance equity and undeposited funds and just, you know, a mess of stuff. If your balance sheet is if the balance sheet is a mess, the income statement's a mess. There's really no point looking at the income statement until you've squared away your balance sheet. Every correction on that balance sheet is going to have an offsetting correct. Almost everyone is going to have an offsetting correction on that income statement. And you know, QuickBooks is just oblivious to that. So, you know, you need someone on your team needs to have some financial savvy to put together, take that QuickBooks data and keep it in the form of, you know, financial statements and books and records that can support a tax return. Do you recommend utilizing a CPA versus a tax preparer account of new business? Yeah, that's a good question. People always ask me, can you recommend someone? It's like, oh my God, you know, every time I have someone, the problem is people, you know, within the CPA industry, people don't major in accounting anymore and become CPAs. It's not a real glorious, you know, path. When I you know, show my age, you know, I went to college in the 1980s. You know, I had my course catalog in one hand, and I had the classifieds in the other, and I had job listings started with A, and majors accounting started with A, and I had a match, and that was for me because I wanted to have a job when I came out. That's, you know, but you know, today is just a different world, and people, there are not a lot of CPAs and accountants coming out. There's a dearth in the industry of finding good, competent people. And CPAs are, you know, college educated, and you know, better educated in accounting and have passed a CPA exam, you know, higher caliber education wise. Although there are plenty of people who are just preparers. The problem with someone who's just a tax preparer accountant, you know, they make their living doing a tax return. And, you know, that's, you do the tax return by churning it out. Here's what I need. You give it to me. They expect you to give them the numbers. And I mean, I can't speak for all. I mean, there's a whole wide range, but yeah, starting out, you know, if you can get a CPA and then, you know, it's a little more expensive and it may be worth it, particularly for, you know, for a while, but you know, then later, if you want to move to something more streamlined, maybe. But yeah, getting started, I think a CPA, you know, or someone of higher quality, I would stick with that. There's another credential in there. Yeah, CPA is going to cost more than a non-CPA. There's another credential that's an EA, enrolled agent. Um, a lot of you can come out of high school, take an exam, and be an enrolled agent. You got to take some online course, but there's not a whole lot. And there are a lot of people who worked for the IRS came out and want to do tax resolution work, and they'll get the EA credential. It allows them the power of attorney form. The IRS power of attorney form will allow a CPA or not a family member, but a CPA, an attorney, or an enrolled agent. But an enrolled agent has no, it's just anyone can be that. There's some you have to pass an exam within the IRS, but it's not a 3-day thing and years of your life like the CPA exam. And how much they cost, it's all over the place, and some people are retired or they were with big firms and they're out and they're doing it on the side and reasonably priced, and other people have big overhead. And if you go to a place with a big overhead, a CPA firm with a big overhead, you got to cover that overhead. Um, um, so, and people do move on also. It's a tough way to make a living. Being a CPA, it's just strange. There's a shortage of it, but also it's kind of a tough way to make a living because people don't want to pay. A lot of people think that's just I guess a lot of people are doing stuff themselves. I mean, they get in trouble. And come to me, and it's a lot more expensive. But I don't know. There's a whole range out there, so that's what I got on that. But somebody does need to know what to do. Either you, or an accountant, bookkeeper, or whatever. Bad preparer. How we're running out of time here. Bad preparers. Watch your preparers carefully. I mean, I see bad preparer cases. Federal indictments, incarcerations, all over the place. Happens all the time. And generally they're not credentialed. Sometimes they're credentialed, CPA or even enrolled agent. Generally, they're not credentialed. They're just hanging their head out as a tax preparer, and they're generating false returns. I mean, they're telling you that this is how you do it. This is what you do. It gets you a big return, and they're just crooked, and they're also ripping you off. I mean, they're ripping you off because they're telling you, that what you're doing is legal, what they're doing for you, but also they're ripping you off on your fee. They're getting you a big refund, and they're directing part of that refund to them. Then the IRS is going to turn that around and claw that refund back from you, not from them, and you're left holding the bag. It's a very raw deal when people get caught up with these bad preparers. It's not even, people say, well, they got me a big refund. Well, yeah, when tax returns are filed initially, they're processed with minimal scrutiny. I mean, you got really, have like a $500,000 refund or something, something really, sketchy for it to put a hold on it. And sometimes they don't even do that. I mean, so just to say, so when they got me this big refund, that really doesn't mean much because the IRS just processes a claim for refund. They're required. The thing is, there's a time constraint. I mean, the IRS is a resource challenged environment, time constraint. They have to get refunds out by law. They have to get refunds out by a certain date, or there's interest and there's other problems. So really push to get those refunds out. A lot of people might not know this, but if you file you and your partner or someone, you each file a return, you file a refund return, your partner files a balance due return. Your refund return gets processed first. Refund returns get processed and refunds issued before they even process or move forward on the balance due or follow up on the balance due. Because they have a lot more time to work the balance due issues. They're under the gun to get the refunds out. So bad preparers carry out false refunds all the time. And here's a big refund. It was really a super big refund, but the preparer kept half of it or more, rounded it to their own account. Or they presented a return to you, shows you what the refund is, but what they e-filed is a different one with a larger refund and played games with that. And then I've had audits where people say, here's my tax return. And the IRS says, no, that's not your tax return. This is your tax return. And it turns out that what the preparer submitted, what they gave you to look at and sign and approve is one thing. What the preparer filed was something else with a much larger refund that he absconded with. Happens all the time. So having a CPA is a much better route as far as that is concerned. There's a state licensing board that licenses, does background checks and compliance and ethics and all that stuff. Bad CPAs get kicked out pretty quickly. So not saying there's no bad ones, but if you get a crooked CPA, it's a deal that's worth several millions. It's not, he's not taking your $2,000 refund. Yeah, CPAs, licensed, enrolled agents. IRS can remove an enrolled agent, but basically it's just one exam and registered with the IRS. Everyone else, it's a free for all. There's plenty good out there. I don't mean to disparage uncredentialed preparers. There's plenty of good ones out there, but it is very much buyer beware. We don't have much time, but I want to talk quickly about the criminal stuff. Where most people get in trouble with regular income tax, you're not going to face incarceration over a mistake. Everyone watch Legally Blonde. It's actus reus and mens rea. You have to actually not only do the wrong thing, the bad thing, but you have to intend to do the bad thing. You have to have a mental state that you willfully did this bad return. Just a mistake won't get you there. You'll pay some big civil penalties and fines, but you're not going to face criminal prosecution or incarceration. Payroll tax deposits is where this goes sideways. Payroll tax deposits get it's almost a strict liability crime. A strict liability crime is one where the act itself is the crime. The mental state, the mens rea, the Legally Blonde, isn't really a factor. You did this act, that is the crime. There aren't a whole lot of these in tax, and payroll tax is a little bit of an exception, but pretty much payroll tax, not filing the payroll tax returns, not funding the payroll tax deposits, not withholding to begin with. Those are criminal acts, and they get really bad really fast. The statute is pretty straightforward. Anyone who fails to collect, account for, and pay over any tax imposed by this, which means any payroll tax, shall be guilty of a felony. $10,000. When you get to there, it's like take my 10,000 or 5 years, and it adds up fast. Because each quarter can be a separate count, and it gets there. When we have people come in with payroll tax issues, one of the first questions I ask is, do you have any prior felonies? And if the answer is no, we will say, well, we'll try to keep it that way. But the payroll taxes deposit, it's not just another bill. And we've had cases like this, and it's kind of heartbreaking. But early in the process, it's like, well, I didn't have enough money. I knew not paying someone's bad, but I didn't realize that if I paid subcontractor, or if I paid payroll tax but not subcontractor, it's a civil matter. I could be sued. But if I paid the subcontractor, not the payroll tax, it's a felony. I didn't have that level of understanding, but that is the rule. The payroll tax is not a tax bill. It's your income tax is a tax bill. If you don't pay the income tax, that by itself isn't criminal. You can get the payment plans and stuff. But the payroll tax, it wasn't your money. When you sent a paycheck, create a paycheck, and you paid someone the net pay, and you withheld the difference to turn over to the IRS, that was not your money. You withheld that money. The crime is similar to embezzlement. You took those trust fund monies that were held out, and you, instead of paying it over to who it was supposed to go to, you commingled it into your own affairs. And it's not like it's not like you say, "Oh, great, it's the perfect crime. I'm going to not pay these payroll tax. I'm going on vacation or cruise." No, you're struggling to make the bills and stuff. That's how it goes south. You paid the rent instead, but that's still an embezzlement because it wasn't your money to pay that rent. So that payroll tax is probably the most frequent trip up point for new businesses. They treat the payroll taxes as just another bill, and they get behind on that bill. And then you're talking about sentencing guidelines and prior felonies and stuff like that. So if there's any takeaway from this, don't let the payroll tax get away from you. If it's getting away from you, shut it down. Go do something else. It is not worth. The minimum incarceration really is 12 months. Even if we can negotiate a house arrest and probation, and you're still a convicted felon for the rest of your life. Don't play games with payroll tax. That's don't do that. Okay. All right. What questions do I have? Any questions? I know we ran out of time here. Sure. Oh, cool. I don't know, anyway, anybody? Okay. Bueller? Anyone? Okay. Okay. Shelby, do you want to take over?
I think um I I don't have anything to add, just if folks need to locate an attorney here in Mecklenburg County, the Mecklenburg Bar Association does offer a lawyer referral service, or if you can't find one through us or you might need one for another county, there's also the North Carolina Bar Association. We have a whole list of resources available on our website at mecbar.org, or if you need to reach out to me directly, I'm happy to try to point you in the right direction. Most of all, give a shout out to Rick Yandel for giving us such a wealth of information and helpful, practical tips to set us all up for success.
You.
All right. I think that pretty much wraps us up for today. Here you have Rick's information if you need to reach out to him directly. You can also reach out to me at mecbar.org. And I think we're going to call it a Monday.
Thank you.
Thank you, everybody.